let's talk about something called off-balance sheet financing. Now, I know that sounds a little technical, maybe even a bit dry, but trust me, understanding this is the key to seeing how some of the world's biggest companies can hide billions in debt right out in the open. This is a story of financial engineering so powerful it has brought corporate giants to their knees. And today, we are going to pull back that curtain.
So let's start with a question that just seems to defy all logic. How is it possible for a company that looks totally safe, totally solid one day, to suddenly be teetering on the edge of collapse the very next? This isn't a trick question. It's a critical puzzle that anyone who invests in a company or even works for one really needs to understand.
And the answer, almost always, is hidden just below the surface. A company's balance sheet, that's supposed to be its main report card, right? Its financial health in black and white. Well, often, that's just the tip of the iceberg. It shows you what's visible above the water. But the real danger, the true weight of its debts, is lurking just out of sight.
So, let's do it. Let's go beneath the surface and explore this financial iceberg together. We are going to uncover what really lies beneath the numbers you see on paper.
Okay, so what is off-balance sheet financing, or OBSF, as you'll hear it called? Well, put simply, it's a toolkit of financial techniques, and they're often perfectly legal, that let a company borrow money or use a major asset without having to list that debt on its main balance sheet. The key thing to get is that the obligation, the debt, is very real. You just can't see it in the most obvious place you'd look.
This slide right here illustrates the fundamental trick perfectly. Look on the left, you've got the normal way of doing things. A company buys a machine, it takes out a loan. Simple. The machine shows up as an asset, and the loan shows up as a liability. Both are right there on the balance sheet for everyone to see. But now, look to the right. With off-balance sheet financing, the company still gets to use the exact same machine. But because of a special contract, the legal ownership, and more importantly, the debt, belongs to a whole separate entity. So the company gets all the economic benefit, but the debt just seems to vanish from its books.
And this, right here, this is why they do it. It's all about polishing the numbers. Let's take the debt-to-equity ratio, a huge indicator of risk for investors. With normal debt, that ratio goes up, screaming higher risk. But with OBSF, it stays nice and stable, making the company look way safer. Or how about return on assets, ROA? Well, OBSF makes the company look more efficient by making its ROA go up. The bottom line is, these techniques make a company's financial report card look much, much healthier to the outside world. But, and this is important, this isn't always some sinister plot to deceive people. Off-balance sheet financing is a classic double-edged sword. It can be a completely legitimate, even a brilliant financial strategy. But it can also be an incredibly powerful tool for deception. So, what are some of the good reasons for doing this? Well, beyond just making the ratios look pretty, it's often about smart risk management. For example, a company might have loan agreements, called covenants, that limit how much debt they can take on. OBSF lets them get new funding without breaking those rules. Or, and this is a big one, they might want to wall off a really risky new project so that if it goes belly up, it doesn't sink the entire company. And this is a fantastic analogy for one of the most common tools they use, something called a special purpose vehicle, or SPV. Just picture it like this. A huge corporate ship launches a separate little boat. That little boat is loaded up with a single risky project. Now, if that project fails, if the little boat sinks, the main ship just sails on, totally unharmed. It's a really smart, legitimate way to manage and contain risk. But what happens when that same tool is used to hide the truth? Now we're going to turn to the dark side to look at what happens when the numbers lie. These are some cautionary tales from corporate history that every single investor really ought to know. This quote from our source material just nails the central danger. The true economic leverage and risk exposure of a corporation may be vastly different from the figures reported in its audited financial summaries. What does that really mean? It means what you see is almost never what you get. The reality can be a whole different and much scarier story. And the poster child for this, of course, will always be Enron. Their playbook was an absolute masterclass in deception, using those very same SPVs we just called a smart tool. First, they hid their bad investments by selling them to their own SPVs, creating fake profits out of thin air. Second, those SPVs had to borrow billions to buy these assets, but none of that debt ever showed up on Enron's books.
And the final, fatal move? They used their own company stock as the collateral for those loans. So when Enron's stock price started to wobble, the entire house of cards came crashing down.
Now, for another infamous case, Lehman Brothers and their Repo 105 trick. A repo is basically a short-term loan. You sell an asset and promise to buy it back a little later. Well, Lehman turned this into an art form of deception. Right before they had to report their quarterly numbers, they would sell a ton of assets to get a pile of cash. They'd use that cash to temporarily pay down their debts, making their balance sheet look fantastic on reporting day. But, and here's the trick, as soon as the report was out, they'd buy all the assets back and all that debt would magically reappear on their books. It was a perfectly timed illusion, pure financial window dressing.
And please don't think this is just some problem from the history books. The collapse of Greensill Capital back in 2021 is a huge modern reminder. Their specialty was something called supply chain finance, but their fatal trick was financing future receivables. Basically, they were lending money against sales that had not even happened yet. This let their clients hide billions in what was really debt, classifying it as simple money owed to suppliers, until the whole thing imploded.
Okay, that was the scary part. But the point here isn't just to tell you financial horror stories. The goal is to build your financial intelligence. So now we're going to give you a toolkit, a guide, for how to read between the lines and spot these hidden dangers for yourself.
So where do you find the truth? Well, it's almost always hidden in plain sight, buried deep in the footnotes of the financial statements. This is where the real detective work happens. You have to comb through sections with boring names like commitments and contingencies to find hidden guarantees. You have to look for disclosures about variable interest entities. Those are the SPVs we talked about. And you absolutely have to pay attention to related party transactions and any mention of supplier finance programs. The clues are all there, if you just know where to look.
And you know what? This is exactly what professional analysts, the folks at the big rating agencies, do every single day. They never take a balance sheet at face value. They do something called analytical adjustments. They read those footnotes, they find the hidden debt, and they manually add it back onto the balance sheet themselves to see the true, unvarnished picture of a company's health. They essentially unwind the accounting magic to get back to the economic reality.
And that brings us to our final and probably most important point today. A clean-looking balance sheet is just a starting point. It is not the conclusion. True financial intelligence isn't just about reading the numbers that are printed on the page. It's about understanding what's written between the lines. It's about asking the right questions and always remembering that the most important information is often the information a company would rather you didn't see.